Friends and enemies, welcome to another Wednesday episode of the Canadian Bitcoiners podcast, where I have forgotten to turn on my Bitcoin light once again, much to my mother-in-law's chagrin, I'm sure. My name is Joey. We got a dinger, a heater for you tonight. We're going to be throwing aspirin 100 kilometers across the plate here, 100 miles across the plate with a man who needs no introduction. He's been doing the rounds the last little while. We'll save the intros here, and we'll get to the interview in a sec. We'll talk about the sponsor, of course. You know him. You love them. EasyDNS, best place for you to host a website, do a little work on your content game. Most important thing about EasyDNS, okay? On top of them shepherding Len and I through the minefield that is domain hosting, the minefield that is content hosting. Mark, the proprietor, founder, wrote a book called Unassailable, which is actually behind me here, about the dangers of becoming cancelable, deplatformed, et cetera, in the age of electronic communications. We've seen this many times in Bitcoin, many Bitcoin channels, Bitcoin Twitter accounts getting deplatformed, de-amplified, all these things. And it's important to us. And when we eventually get around to creating a website, which I've been saying now for, it seems like more than a month, it's going to be great to be with EasyDNS and not worry about the critics of the Bitcoin mission and maybe most importantly, the critics of our opinions on some of the current affairs. So we're happy to be with Mark and EasyDNS. And of course, if you haven't checked out Access of Easy, which is the other show we do for EasyDNS, it's on our feed. You can subscribe to it if you subscribe to our show and enjoy that kind of tech and privacy talk. It's critical to Bitcoin. Let's bring in our guest, CJ Konstantinos. This is, first of all, okay, this background, like I've been like struggling with the background here. I'm just finding like a sort of assorted trinkets that I've acquired over the years, some Bitcoin, some not. My wife's a graphic designer. I have some graphic design books here. No one's really called me out on any of this yet, CJ, but we bring on guests once in a while who have like these kick-ass backgrounds, like Max Gagliardi we had on a little while ago. Great background, lots of levels. Obviously Ben Parents, BTC Sessions, great background. And now I got to contend with this. Like, what do you have to say about this before we get started?
Ooh, baby. Bitcoin is commoditized energy in the form of money. And that is what that picture is. It's 1,000 different words and it has such deep meaning. I love it. So until I get a full-blown studio, Bitcoin as commoditized energy in the form of money will be my backdrop.
We got to figure that out. I got to talk to our sponsor and see if we can get something done here because I don't know. As much as I like the Raptors surfboard, which I was sort of conned into buying probably after a few beers in Mexico, might be time to upgrade. Okay, so CJ, first of all, thank you for coming on. It's good to see you. Good to talk to you finally. Tell me a bit about your background. You are a Bitcoiner of a longer vintage than I think many people realize. So when did you get in? How'd you get in? Give me the story there.
Yeah, well, first of all, thanks for having me. I really appreciate you giving me a chance to speak out and share my passion with Bitcoin. So thank you. I started back in 2013. Jeff Berwick, the dollar vigilante, told me about Bitcoin. I wasn't smart enough to listen. It took a year of just watching before I took the full dive. But in 2014, I took the full dive. And so, I'm going on my 9th year and I've been in mining. When I say deep dive, I mean, like I went to the bottom of the rabbit hole, planted some dynamite and then went deeper, So it wasn't just like, okay, this is cool. I'm with it, back onto my life. It really started to become a part of my life. And then after the 2016 halving, just being involved produced financial freedom for me. And with that financial freedom, I had a lot of extra time and energy, and I decided to reinvest it into Bitcoin. So that's when I really started building out my mining and building the Bitcoin fair value algorithm for treasury management and just kind of understanding what the asset class is and where it's going in the future.
So that's a good start here. Let's pull on one thread there. You also run, of course, a BTC Fair Value Twitter account. Tell people about that. I don't know how many people realize you also run that account. That's been popular on Twitter for a time. And I think a lot of people, myself included, up until, a couple of weeks ago, I didn't know you ran both. So tell me about that. What is that? What does it do? Why are you doing that?
Yeah. So I was Annan and I wanted to be that way. It's kind of bad OPSEC to hop out in the spotlight, but too many people were like, listen, man, what you understand about Bitcoin and how it applies is just too valuable to hold that back. And what really convinced me is someone told me, think about the legacy for your children, and that really hit me hard because I'm in Bitcoin because I'm thinking about my kids and my kids' kids. So I can apply that same understanding to producing content for fellow Bitcoiners, and for people to not get my interpretation, and for me to hide that interpretation, even from my own children, to not have a platform that they can reference back to understand some of these things. That really hit me hard, and that kind of pushed me out into the spotlight. So I had some supporters, reach out, and Ben from BTC Sessions, he was the first one to give me an opportunity to speak. So, shout out to him, and a big thanks to him for what he does, going out there and giving Bitcoiners an opportunity to step up and to, say their piece. So I really appreciate that. And you for doing the same thing.
No, man, absolutely. We're happy to. We try and give a platform to Bitcoiners who I think understand the mission. And we're going to get into some of your views here, CJ. I have the, typical kind of show notes that I refer to on the side of my screen. Sometimes I look at them, sometimes I don't. And to be honest with you, when I make them, oftentimes what I do is I want to give the guests a chance to kind of play the hits and maybe pull on a few threads. But I had a hard time doing that with you because it seems to me that you don't really have hits the way a lot of our guests do. You have a lot of deep views that are sort of wide ranging, touch on many different subjects. And so I've decided to break the interview into 3 parts here. And we're going to talk about the monetary system, of course, Bitcoin's role. But I think the best way to handle this, and we'll try and do it in an hour, is to start with maybe the past when it comes to the monetary system, the current system as it's, kind of constructed and pragmatically applied the world over today, and the future of monetary systems and currency systems. And I think maybe it's best before we start that we draw some lines in the sand. Chief among them, the line that you've drawn in the past between currencies and monies. This is important. Not a lot of people talk about this. Do you want to maybe give us a breakdown of that before we start?
Yeah, absolutely. And you're right. It's absolutely critical and important. And I have to shout out Mike Maloney because his Hidden Secrets of Money was one of the first things I came across when I started to study the difference between currency and money. And, money is equity and currency is simply a derivative. And that doesn't mean it can't be a derivative of money. Like when the dollar first started, that currency was a derivative of gold, and gold was the money. So the derivative of the value that backed the currency was actually real equity. The problem comes in when you talk about where we came from in the past, where we had an honest system, and the problem is we had to trust it to stay honest, right? And that's the difference between Bitcoin and humans. Bitcoin is a decentralized community that we can trust, and a couple of people liked my quote where nodes trust nobody, so that everybody can trust anybody. So that trust that's placed in a centralized institution is then replaced in a decentralized social network. And then that mistrust between the people within that network who run their nodes affords everybody else the ability to trust. So that's a really important concept because it was the trust that gold-backed dollars established that the politicians were able to take and bankers were able to take advantage of when they changed the system. So by the time we were on a quasi gold standard going into 71, anybody could turn in those dollars and get gold in return. But when they took the gold away from backing the dollar, that's when the dollar really died. So a lot of people are like, well, this is just happening now. We got plenty of time. No, it's been over 50 years where the dollar's been dead. It's just now that we're finally starting to realize it. So if you think you got plenty of time left, you might want to just recalculate and readjust to understand that this current dollar, which is a derivative of debt, because when they remove the gold, they replace the backing with debt. And when you're a derivative of debt, that means the value is the promise of tomorrow's production. Equity is proof of yesterday's work. So when you're taking tomorrow's production and pulling it into today, you're destroying the future. There's no way to build sustainably when you're stealing from the future. Instead, you need to build on top of the work that's been done in the past in order to build a successful economy. And with dollars being a derivative of debt, there really is no way to reach that goal. And that's what got us to where we are here today, where the conversation is not about the perpetual survival of the dollar. The real talk is what comes next. A lot of people are talking about central bank digital currencies. A lot of people are talking about the BRICS nations coming together, and maybe the Chinese yuan or the Russian ruble, or maybe they come together with some kind of BRICS basket of currencies that's backed by gold. The talk is where are we going to next? So it's pretty much a done decision that debt derivatives are not sustainable. And I think there's a disconnect in the market right now who think, well, we can keep going on. We can, this can keep going. No, it can't keep going. And people are still going to trust through the whole process. But the people who trust all the way to the end, they're going to be fully diluted. They're going to be left holding the bag. And I think a lot of people think that's coming 5, 10, 15 years down the line. Look at what's happening in the news today. Like you said in that tweet earlier, there's so much going on. There's so many avenues we can go down. I mean, President Xi and President Putin are talking about how there hasn't been this type of change in 100 years. What were they talking about? The dollar has been dominant for 100 years. It's been dead for 50. And now people are starting to recognize, they're waking up to that ability. And where we were in the past to where we were now to where we go into the future, to me, it's plain as day. And that drives some of the passion that I have to come out here and do the circuit to let people know. 2016, I got laughed at when I was talking about inflation. Now people have come back and said, hey, man, I see what you're saying. I'm working longer. I'm making more money, but I'm buying less stuff. What the hell's going on here? And that question's finally being asked by the masses.
So do you have a view, CJ, on whether or not 71 is actually the key year in the sort of death, as you call it, of the dollar? Or do you think that there was like a key event or a couple of key events in the years leading up to that? I've never asked a guest that question, but it seems like if there was ever one to ask, it might be you. Do you have a view on that?
Yeah. So you have to think of it as like an equation. Nothing changes in the output of that equation until you change one of those variables. So you can think about changing a variable, but until the actual input is changed, the output will not change. And that's exactly what happened with the dollar. As soon as those dollars were not redeemable for gold, it became a derivative of debt versus equity. From that point forward, everything changed. The entire incentive structure, the time value of money, all of these things. Actually, I'm sure your viewers know it, but I'm going to shout it out anyway. WTF happened in 1971. And you can look at, they have charts upon charts after charts of all the different trends that started in 71 when we finally changed that variable and moved from an equity backing to a debt backing. It truly was the catalyst to the end of the dollar's currency life cycle.
So I think that's a good summary of the problems that we ran into about 50 years ago, as you mentioned. I know that the, typical kind of, book on the shelf understanding of fiat currencies is that sort of regime, that kind of hegemon lasts about 50 years. And so we've kind of also passed that checkered flag, that finish line as well. So let's talk about some of the things that are going on today. Obviously, you've mentioned inflation. We talk about that a lot. Bitcoiners are keen to touch on that with normies and with other people in the space alike. There's a lot of talk about inflation, treasuries as a quality reserve asset, a quality foreign asset. And I think some of the things that are just now coming to light in places like Canada are the problems that the US dollar hegemony causes for other countries. As the US tries to defend the value of its currency, what's going to happen to other currencies like the Canadian dollar, like the euro? These are important currencies that so far, thanks to that hegemon, haven't really been tested in this way. There's not a book on this as of yet. And so let's start with what you view as the current sort of international level of trust in the US dollar. Do you think that there's been a come to Jesus moment from sovereigns about the trust in the USD? Do you think that there's, the same closed door meetings happening in Russia, China, India that are also happening in other European countries? Or is there a clear line there between adversaries of the United States dollar and perhaps allies? My suspicion, CJ, is that though none of these countries will talk about it out loud, I think everyone views the dollar as in decline. As you mentioned, seems to be some agreement on this thing coming to an end. What do you think what do you think is going on behind the scenes in some of these countries? What are they thinking about the current state of trust in the dollar?
Yeah, that's a fantastic question. I think they're at different levels depending on who they're allied with. So you see the BRICS nations they've come out and straight said it. We're going to create a global reserve currency to compete with the dollar. So you can't be any more clear than that. I mean, they literally have said that verbatim. So that brings us to a whole nother level with those countries. And this was really started by the United States weaponizing the dollar against Russia. I sent a tweet out earlier today where I said, unfortunately, it looks like the dollar's dying by a death by 1,000 cuts. And it's just so sad that the US government was the person who did the first couple of cuts, almost inviting everybody else in to come in and take their slice. Now, one thing you said about the other currencies relative to the dollar, this is really important, because what happens is when you're the reserve asset of the globe, right, the entire economy of the world, what that does is it creates a huge base layer of demand. And this base layer of demand is necessary in order to keep positive price pressure on the dollar. And, you know, a lot of Bitcoiners get upset when I say this, but it's an economic reality. When you're the global reserve currency, your currency is deflationary. You know, so it's not the system itself. History needs to remember it's the politicians and bankers who yielded the system and corrupted the system in favor for themselves. And, you know, if you think about it, we are the savers. The savers are the lenders. The banks are the borrowers. The governments are the borrowers. So it becomes clear as day when you can look at the marketplace and say, well, wait a second. Debt used to be an asset for the lender, not the borrower, right? It was the person who was lending money who would get the yield. In today's world, in real terms, it's the person who's borrowing the money who gets the yield in the form of increased purchasing power. I said it like this in the previous show. I do believe in the future, people who have 30-year mortgages will one day be able to walk out into the street, pick the dollars up off the ground, and pay their mortgage. That's not an asset for the lender. That's a liability for the lender. And of course, they rigged the system like that because they're the borrowers and we, the people who are the savers, are the lenders. So that's the first problem. They've clearly rigged the system for themselves to empower those who are borrowing, because they're borrowing way beyond. With fractional reserve banking, they're borrowing at 100x of the liquidity that savers can provide. And that's where we get the problems where we have today. But the second thing is as the world grows, as the rest of the world grows, and the demand on dollars grow, if the demand on dollars grow, but the supply stays the same, basic economic principles tell us the price of the dollar is going to go up. So being the world reserve currency, the United States had the privilege to be able to expand its currency supply and not cause inflation. But they had to expand the currency supply at a rate that matched the growth demand. So as long as they expanded the supply at a rate where demand was expanding, then supply demand equilibrium remains the same. Therefore, the price remains the same. So this isn't about a flawed system. This is about flawed people who mismanaged the system and who abused the system and who corrupted the system to make it in favor of themselves, the borrower, instead of in favor of the savers. Bitcoin flips that script upside down and empowers the savers and makes those borrowers actually take risk. But the dollar, being in a position of dominance, is what allowed it to be created in order to match that demand without being inflationary. Now, obviously, the rate at which we're creating dollars, over 40% in the last 2 years, is far outpacing the growth in demand. And a lot of that has to come back with them not only corrupting the system and manipulating it to empower themselves, but now going into the academia and redefining inflation, redefining CPI by changing the equations, performing what's the word I'm looking for? Performing
hedonics.
Hedonics and unhonest alterations in order to keep the trust of the people. Because the fact of the matter is when trust is lost, the dollar will hyperinflate. The only difference between inflation and hyperinflation is trust. And that's what's concerning to me, because like you said earlier, where does the rest of the world line up with this? Obviously, the BRICS nations have lost trust. They are openly competing. Now, what about our allies? It's hard to say. The euro, they had negative interest rates. Now they're raising quick. Everybody is mimicking what the Fed is doing. And I think that's the biggest mistake that everybody is making. If we just do what the Fed does, then everything will be okay. Yeah, until it's not okay. And now it's not okay. So even these BRICS nations who are trying to come out and compete with the dollar, nothing can compete with Bitcoin. Nothing can compete with gold. Nothing can compete with silver. These are the three hardest monies in the world, Bitcoin being the number one hardest, obviously, with a finite supply. We can find more gold. We can find more silver. There are not going to be more than 21 million Bitcoin. So Bitcoin is the hardest money in the world. So now it's not that they're competing with the dollar, because the dollar's gone. We are watching the end of the currency life cycle with our own eyes. Now it's about Bitcoin, gold, and silver. They can't beat it. I think they understand that. And that's why this is a war of attrition. World War III is being fought in the financial markets, and they are slowly chipping away at dollar dominance, because it's not even about the price of the yuan against the dollar or the ruble against the dollar. What it's really about is getting the base layer of demand to shift away from the dollar and into other currencies. And as the supply of the dollar increases, but its demand decreases, that same economical principle tells us the price is going to go down significantly.
For sure. And we've talked on this show, and I'm sure you know this as well, the sort of petrodollar dynamics. If a country like India goes away from paying for oil and oil products in the US dollar, demand falls off a cliff, to your point, and changes that equilibrium. It's important to remember these things. I think a lot of people kind of get, I say this a lot about Bitcoiners, especially the new Bitcoiners, get kind of lost in memes and laser eyes. And it's important to know that there's a lot going on besides the memes and laser eyes. The memes and laser eyes are good, but there's other stuff going on that's important that will help you kind of spread the message. Now, I'm going to ask you a question about something you mentioned there. Trust in the US dollar and trust being the difference between inflation and hyperinflation. Don't you think that it's fair to say we haven't had trust in the US dollar in 30 years, basically since the sort of retail stock market was available to the average Joe and average Jane? No one really saves in cash. And so I'm wondering, what is the line for you between trust and not trusting it? Because in my view, we're already there and we haven't quite seen hyperinflation. I know this is kind of a foggy term and difficult to define. And as you mentioned, the definition is more fluid than it should be at the moment. But what is your view on that? Didn't we already lose trust in the dollar, or am I missing something there?
Yeah. So a couple things. First thing is petrodollar demand is obviously large, but it's small in comparison to the euro dollar market. And when I say euro dollars, I'm not talking about the euro. I'm talking about the dollars that are created by foreign banks, because it's not only American banks that have the ability to extend dollar denominated credit. Foreign banks can extend dollar denominated credit as well. And the euro market for dollars is much larger than pretty much any other market. It has its separate yield curve and everything. The Fed is currently wrestling with that. So a lot of that demand is based off of foreign entities who own US assets and therefore receive cash flow in dollars, but then they have to bring that cash flow back to their country and change it back into their own currency. So if the dollar is gaining against their currency, that's fine. They're increasing their purchasing power. But if the dollar is losing against their home currency, then they're actually losing purchasing power. So there's literally a whole bunch of leveraged hedges to the tune of 1,000 trillion plus of all these entities, foreign entities that own cash producing assets that produce dollar cash flow, that are hedging the value of their dollar against their own native currency. So a lot of this demand, a lot of this trust, it's created by these financial tools that exist. It's a way that somebody can become delta neutral. In other words, if you have a position and it's delta neutral, it doesn't matter if the price of that asset goes up or down. The value of your portfolio is going to stay the same, right? It's like owning spot Bitcoin and being short 1x. If spot goes up 10%, you're up 10%, but your short's down 10%. So push comes to shove, your position is still even. So yeah, you're right. There is a lack of trust, but it's more so based because of there's all these different financial tools and products that exist in order for these entities to hedge against these different movements of the dollars. Now, that's on a sovereign level and a corporate institutional level. On a personal level, that's where I think the trust is going faster, because people never realized that it wasn't okay to save in treasuries. Very wealthy people, especially old money who have old businesses with cash flows, they don't even pay attention to those things, right? They're too worried about doing whatever social thing they're involved with. Most of them aren't involved in the day-to-day management of that money. They have financial managers, family offices, hedge funds. They're just making sure that the number goes up and it doesn't go down too much. And that's really all they care about. They put their time and energy and effort in other things. For the first time in a long time, we're starting to see those people ask questions like, hey, my business had a 10-year plan. We were supposed to break ground and build 3 factories because we stored $100 million in treasuries and we did it in 10-year notes. Well, here we are now 10 years later, and you're telling me that I can barely afford to build 1 factory? What happened? That doesn't make any sense. We were supposed to build 3. Now we can only build 1. So the massive dilution of the dollar is now waking up a whole class and genre of people who at one point didn't care to now start to ask the question, say, what the hell is going on here? At what level does this dilution need to be taking place in order for this to go from 3 factories to 1? Is this something I'm concerned about? I thought we were hedged, and now all of a sudden I'm getting 66% less than what I was supposed to get. And when the United States puts people in that position, and not only just people and companies and sovereigns themselves, but pretty much the whole world, in that this is the result that you get. It's death by 1,000 cuts, and we've done the first few cuts ourselves. So trust is on the brink. And just one more thing to add right there on the mathematical definition of hyperinflation, because you're right, it is hard to pinpoint where this happens. But with the case studies that I've looked at, there is no mathematical point at which hyperinflation starts. Sure, the textbook will tell you, hey, 50% per month is hyperinflation. But, maybe that's with a society who doesn't really understand that much about money. In a money-centric society, or I should say in a currency-centric society like the United States, maybe it's 20%. We don't know what that catalyst is going to be, where that trust is going to be lost. But one thing's for sure, you can print more or you can print less. But if you don't have trust, you can't print anything. So for me, the best definition of hyperinflation is the loss of trust, because that is honestly what gets the velocity of the money to increase, the amount of times that those dollars start to change hands, because nobody wants to hold on to them, right, starts to increase significantly. And that's what we're seeing now today.
I do like that metric, the speed of money as an indicator, sort of a primary indicator for hyperinflation. If people are unwilling at the retail level to hang on to their dollars, then it does say something about the level of trust eroding. Now, you mentioned treasuries there a few times. Treasuries at the sovereign level, I don't want to say they've fallen out of favor, CJ, but there's a lot of major players, China, the preeminent one at the moment, that have been unwinding their UST position for, I don't know, the better part of a decade now. And, with the Russian weaponization issue, seizing the foreign treasury assets of a nemesis, an enemy, you got to think that other countries are going to start to view the treasury as less than pristine. And even if the dollar somehow maintains its value longer than either of us think it will or can, the treasury market wobbling is important. Do you think that retail, sort of the mom and pops out there, guys like you and me, our parents, little shop owners, people who may not hold treasuries directly, but have pensions that hold treasuries maybe, is this going to be something that helps to wake people up, or ultimately am I worrying a little bit too much about the declining shininess of the U.S. Treasury abroad?
I think you're spot on. I've been saying this since they said they were going to raise rates. So, going back all the way to late 2021, early 2022, when they started talking about this stuff, and then later in March they finally raised rates. But I told people from the beginning that the issue that you're going to create with this is that when you raise interest rates, the principal value of the collateral is going to collapse. And it's that principal value of collateral that is backing everything in the system. So this is not just a problem of the definition of pristine collateral, right? Because that's what I say Bitcoin is the most pristine form of collateral in the world. Why? Well, because it's equity and it can't be devalued. Right? These treasuries, when you increase the currency supply, the way the government does it is by issuing more treasuries. So the treasuries are being diluted at an extremely fast clip. And there are certain laws, Basel banking and other capital ratio requirements that are on banks. There is no reserve requirement since COVID, but that's another misconception, that the banks need our savings in order to loan. They don't. A bank could have 0 deposits and still create credit and create an asset on their balance sheet. So, someone commented on my Twitter post and they're like, Well, banks are running out of money. No, you don't get it. Banks never run out of money. They literally can't run out of money because they can just create it out of thin air. Them and the government are the only ones who can do it. So, when the Fed came out and said, we're going to raise interest rates to fight inflation, I'm like, oh my gosh, just like this world is backwards. It's like upside down. You they're lying because it's just math, right? Would you want to borrow $1 trillion at 1% or 5%? Hello, it's obvious. You obviously want to borrow at 1% because it's going to require less costs. You're going to have to create less currency units. It's better to borrow at a lower interest rate. And then on the banking side of it, most people think of it backwards. And that's because the system itself is teaching these things backwards. But they think of it from the eyes of the borrower. Like, oh, if interest rates go up, then borrowers don't want to borrow. Yeah, that's true. But if a lender doesn't want to lend, then it doesn't matter if someone wants to borrow. You absolutely need the lender in order to make this happen. So it's the lender's incentive set that is more important than the borrower's incentive set. And as those interest rates go up, the banks extend additional credit. Well, when they extend credit, that increases the currency supply. So they're incentivizing the banks to increase the currency supply. And by the way, just because Johnny, who works for minimum wage, is not going to qualify and credit is tightening for him, well, it's not for the people who own his store. It's not for the Waltons. It's just going to make the wealth gap even worse because the people who have the collateral and the equity and the cash flow, the banks are going to be happier to write lower risk, higher reward loans to them. So it's all backwards. They got it all backwards. And through the process of these backwards incentives, they make the problem worse because it forces the rate higher, which creates more currency units. And it's just, it's the wrong school of thought. They're coming from the modern monetary theory school of thought where the government and banks can create any type amount of money and there's no consequences. And they even go as far as saying, well, if banks can't extend credit, there'll be no economic growth whatsoever, which makes no sense because you go back to the free banking era and credit was extended, but it was backed by gold. It was backed by equity. There was something to keep it in balance. And there was a good, strong, healthy credit market. Yeah, rates weren't zero. But look, if the market is set up correctly, rates are meant to help savers, not empower borrowers, right? Going back to what we said, if the savers are making 4 or 5% and the borrowers are actually paying a real rate of 4 or 5%, then eventually the savers become spenders and they become investors and they grow the economy. We're not seeing that today at all. We're seeing negative GDP, right? When you account for CPI the way it's supposed to be, I know I'm not as familiar with Canada's, but I know it's just as bad as the United States. It's probably double that stated rate. Well, when you apply the real CPI as a GDP deflator, our economies are shrinking. So there's only one way to get a shrinking economy and rising prices, and that's the dilution of the currency. And when you understand this, everything else becomes clear. And that is really those real negative interest rates, which is the rate minus the real inflation rate, those real negative rates, that's what's waking up big money. That's what's waking up people who tried to store their value in treasuries and classified them as pristine because after all, look, you're going to get paid. There's no credit risk. Of course, there's no credit risk. The government has a printer. They can print all the money and pay you. The problem becomes, what are you going to be able to buy when they finally print that money and pay it to you? And boom, the light bulb has gone off for a vast majority of the marketplace.
That's a great rolling downhill segment. All our guests are encouraged to black out and roll downhill. I think you just did. That's good. We're going to see if we can get you to do it again. So the question I have for you, maybe about the current state of affairs before we go into what's coming next, is what is your view on what's going to break the camel's back? What's the straw going to be? I think on this show and in Canada and other, I don't want to say we're a socialist country, but we have some socialist tendencies and socialist leanings. One of them, one of the key ones, is the entitlement system. The pensions here are very generous. We have a expanding boomer population that's living longer. And as many Canadian-focused economists have pointed out, our GDP per capita is stagnant. We don't produce much. In Canada, we sell crude, condos, and cannabis, and we gave up on 2 of them over the last 3 years. So I'm unsure of where we're going to get that money, and I think entitlements might be the thing that breaks the camel's back. But I want to know what you think. What do you think is going to be the straw that breaks the camel's back for the sort of general population?
I think the next wave of inflation is what's going to break the camel's back. If you look at, especially in the DXY for the dollar, a lot of the inflation that took place in the United States, as bad as it was, took place during a time where the value of the dollar was increasing. So imagine that, the value of the dollar relative to other fiat currencies was going up, but at the same time, inflation was going up. So what does that mean? That means that the value that was being driven into the dollar was actually working against inflation. It was, as the dollar got stronger, inflation was having a harder time going up. Well, this next round of inflation is going to take place during a time when interest rates are being lowered, not being higher, because it was the talk about raising interest rates and then the actual most aggressive interest rate hike in modern history that drove that temporary value, that temporary purchasing power into the dollar to help fight against the inflationary pressures. But we are nowhere. There is a lag time between inflation and M2 money supply. And we are nowhere near adjusting to the 40% increase. So we have only got the first wave of inflation, and we only have this first break because they raised the interest rates. They didn't raise the interest rates. This would have just continued going. So because they raised the interest rates, we had a disinflationary period, which isn't deflation, it just means prices are rising slower. So it's still inflation. But now when they are forced to pivot in the near future and start lowering rates, and the value of DXY starts going down, and inflation is still happening because they're creating more and more currency units, inflation is going to go up twice as fast and twice as high. Inflation was already in the teens when you look at real inflation. Inflation is going to go into the mid to high 20s on this next wave. And that's really going to scare people, because when things go from like $5 to $6, most people are, honestly, they probably don't notice. But when things go from $5 to $6 and then from $6 to $9, well, now it's like, whoa, wait a second. I'm not eating the same amount of meals. The meals that I am eating now only have one side. I used to be able to buy 4 cars for my tires. Now I have to wait to get a buy two, get two. I mean, like, all these things are going to become way more evident in this next wave of inflation, especially, like I said, when they lower rates and the value of the dollar starts to fall. That's going to be boosting the inflationary pressure. So you'll have the natural inflationary pressure being boosted by the devaluation of the dollar. Whereas in the first wave, we had the natural inflationary pressure being held down by the strength of the dollar. And that, in my opinion, is going to be the straw that breaks the camel's back.
I think you're right. And I'll tell you one other thing that I think is important. There's going to be a number of variables that only cycle through and change every so often. One of the main ones is unionized contracts. There's a lot of unions, labor, and even administrative unions here in Canada, probably in the United States too. And when those contracts are negotiated to 6%, 7% over 3 years or 4 years, that's a significant raise. And so I'm going to give you a saying here to take with you, since you will undoubtedly do more podcasts than me over the next week. The difference, as you mentioned, between the earlier set of inflation, the 2020 to 2022, 23 inflation, that $5 to $6, that's a tweet. But the inflation from $6 to $12 is a torch. And that's when you start to see people getting upset, protesting, things like that we haven't seen. And to be honest with you, CJ, we've been very, very lucky here in the Western world that we haven't had to deal with significant uniform civil unrest. And I fear that over the next 5 or 10 years, we may see that. If you're not holding Bitcoin, gold, things of this nature, you may find that your savings are debased in a way that you just aren't prepared for. Seniors and people who are about to retire specifically. I think of people who are relying on pensions, public sector, private sector, whatever. You're not going to be able to retire on 60% of your best 5 years or 70% of your best 5 years if you have to keep paying your mortgage, if the cost of living goes up by 25% over the next decade, et cetera, et cetera. And so you're going to see problems here that I don't think many people are ready for. So I'm glad you said that. I happen to agree. I don't know if there's other things that I'm missing, but I think this is a big one for most people. Now, great. We're on pace. We're making a nice pace. We did 1/3, 20 minutes on the past. We've done about 20 minutes on the present. And now I want to do between 15 and 20 on the future. And there's a number of potential outcomes, I think, here. Some including Bitcoin prominently, some including Bitcoin playing a minor role, and some perhaps maybe not including Bitcoin at all. And the first question I have for you, CJ, is how do you view the next phase of world reserve assets? Is it multi-reserve? Is it uni-reserve? Do you have a thought on whether Bitcoin is a base layer? Is it a transactional layer? Is it as you mentioned, the next pristine asset for the world? What do you think?
Yeah, great question. And man, it's a multifaceted answer because it has to be. But yeah, when I first started, Bitcoin was digital gold. But what we're seeing now is it's evolving into digital collateral, right? So digital gold is a store value market that's about a 12, $14 trillion market. Digital collateral is a multi-$100 trillion market because it's the backbone of the entire system. And what we're seeing is we're seeing two systems come to butt heads. We're seeing the traditional system where it has those debt-based derivatives that are backing everything. So you have debt times 10 and then debt derivatives times 100, and there is no equity there, versus Bitcoin in the free market internet economy. And the biggest difference between these two economies is that there is no free market in traditional finance. And that's a hard pill for a lot of people to swallow, especially the older people. But it's true. What if they can't tell us the price of chicken, if they can't tell us the price of milk, why can they tell us the price of money? It is not okay for the price of money to be determined by a group of men. The price of money should be determined, like every other price in the marketplace, by the free market price discovery cycle, a supply-demand equilibrium. When the supply of money is high and the demand for money is low, rates should fall. When the supply of money is low and the demand is high, rates should rise. This would be a free market pricing of money. And Bitcoin in the internet economy is the only money asset in the world that offers free market interest rates. That is why we're seeing the system fight against Bitcoin and against decentralized finance more so than anything else in the world. It's actually fighting so hard, it's exposing itself. It doesn't like to expose itself and make these things obvious, but it has to because it can't compete with an open free market. So yeah, I think Bitcoin is transforming from digital gold to digital collateral. I think Lightning Network is a really good example of that. You know, earlier we talked about monetary velocity. Lightning is about increasing Bitcoin velocity. It's about promoting the circular economy in Bitcoin where you can settle with people. You don't need block space because that transactions being batched and settled later. So it's about increasing the velocity, which is always going to be good for the underlying asset. And in the traditional world, velocity is extremely low. You look at the Federal Reserve Education Department, you look at the velocity chart, it's really low. And actually after COVID, I thought it was going to take a quick spike because they were putting all that money into the system, especially directly into circulation in consumers' hands. And it still didn't really go up, but just
really, it didn't go up during that. Wow.
Didn't go up. Just it kind of like consolidated. But just recently, velocity has started to increase. So this is something I'm keeping a really close eye on because it's a telltale sign that dollars are starting to move hands faster. And that it could be that is people losing trust and getting out of the dollar. Now, the second thing here that plugs into what my opinion on this is that we still haven't seen the effects of the interest rate raises, right? Just like there's a lag between M2 and inflation. Well, there's a lag between interest rate increases and its effect on the economy. I know in Canada, it's going to be really bad because you guys don't have 30-year mortgages like we do, right? So all of these people who are going to get refied, if those rates aren't down to where they were before or lower by the time a vast majority of these refis happen, people are going to lose their homes. And that's where the social rest comes into play because now at no fault of their own, through a flawed financial product and the mismanagement of the system itself, they will actually lose their home. And that's going to be a big deal. And that's also a big deal, not necessarily in the United States, because we do have those 30-year mortgages and a lot of people have 15-year fixed arms, and there's a whole bunch of different variables. But in the commercial real estate market, it's very similar to Canada. Most commercial real estate developers on a 3, 4, 5, maybe 6-year basis where they have to roll. And now they're coming up where literally trillions of dollars will need to be refinanced, and they will not be able to raise the rents and produce the cash flow to cover the cost of financing the property. So these gross profit on these properties where you would borrow and then re-leverage and collateralize and borrow against and go to the next unit and go to the next and just keep levering up and building more and more debt based on that real world collateral, that's disappearing because as those rates go up, the cost to financing the property is greater than the amount of cash flow that can be produced. That means that you're going to have a net negative loss. So nobody can carry a property at a loss because you can only bleed out for so long. We're not banks. We're not government. We don't have printers. So when we run out of money, that's it. You have to liquidate the property. And when these things start to become underwater, if you're underwater, just stop paying. I mean, that's not legal or financial advice, but it's mathematical advice. If you're underwater, stop paying. There's literally no mathematical reason to pay. So they're pushing the system to the brink of breaking it. And what's weird is they're trying to break the economy, right? We already talked about why raising the rates doesn't fight inflation. But what it does fight is demand. And they're killing demand in economies like yours and ours, where there almost is no demand, right? A lot of the problems were supply chain problems. And yes, their supply demand equilibrium, when the supply went down because of supply demand problems and demand remained constant, the price went up. But that was just one of the price pressures. The other price pressure came from the currency being devalued. So there was a double positive price pressure. Now what we're going to see is we're going to start to see that happening in real estate. So people's lives aren't just going to be affected at the checkout at the grocery store. They're going to be affected about what kind of roof they can have over their head. And that's the political fallout that these people can't afford, which is why I'm not preparing for financial Armageddon. I do not believe we're moving into a time where there's going to be a financial Armageddon and prices are going to crash back down to 1930 levels. You know, everybody's sitting in cash on the side. Look, when everybody's in cash on the sidelines, you should be buying, right? And then when you go to the store, in the grocery store, and the cashier's like, "Hey man, did you ever hear about Bitcoin?" I'm like, okay, it might be time to start raising some cash. You know what I'm saying? When everybody's out of cash and promoting an asset, get out of it. But when everybody's in cash waiting for lower prices, get into it. And that's where we are right now. The whole world is in cash because they can get 4% yield, 5% yield. The real rate of inflation in the United States is 12%. And you're getting
probably higher.
It probably is. And you're getting paid 4% in your treasury. Well, 4 minus 12 is -8. So you're losing 8. Next year, you can buy an 8% smaller house, an 8% shittier car, an 8% less groceries. So people are still being incentivized to spend and invest. But at the same time, they're holding their money on the sidelines because the government says we're going into a recession. We're already in the recession. This is a inflationary recession. That means that growth of production and consumption shrinks, but prices still go up because of the abuse of the money system. All of that's coming to fruition, and it's happening right now.
Okay. I got to ask you a tough question now, CJ. You hold not just Bitcoin, but other crypto assets. Do I have that right?
That's correct.
Okay. So you got to tell me what, and you got to tell me why.
Yeah. So first of all, let me say this. Let me define Bitcoin maxi, because I identify as a Bitcoin maxi. That means that Bitcoin is the reserve asset of the internet economy, the most pristine form of collateral in the world, commoditized energy in the form of money. Nothing can compete with Bitcoin. Nothing. There is no chance of any other network in the world. There's not enough money. There's not enough chips. There's not enough resources. There's not enough time and energy. Nothing can compete with Bitcoin. Bitcoin has already won the fight. If it was going to lose the fight, it would have lost it in the earlier years. The Pandora's box is opened. The fight has been won. Bitcoin is the reserve asset of the internet economy. It is the digital collateral, the base layer money of all future finance will be built around Bitcoin equity. All of it. It's not going to be built around Ethereum. It's not going to be built around any of the other tokens at all, most of which are shitcoins. There's only one reason for the existence of Ethereum or other platforms like Stacks, and that is to evolve Bitcoin from digital gold to digital collateral. So when I first participated in the Ethereum ICO, we'll call it, I figured, hey, I'm going to need some Ethereum because it's going to help me manage my money, right? Because Bitcoin is my money, and I'm going to want to use smart contracts to help unlock some of the equity that's trapped in my money, right? Remember, gold failed because it wasn't acting as collateral. Gold failed because you couldn't post $1 billion worth of gold. And then if you actually had to settle up and fly it across the world, it would cost you more to fly it across the world than it would to pay interest on your loan. So gold failed because it didn't act as collateral properly. Bitcoin will succeed because it's the perfect, most pristine form of collateral in the world with easy, fast, secure settlement. I mean, there's nothing can be compared to it, and nothing else can compete with it. So I just want to make that absolutely clear. And the vast, vast, vast majority of my portfolio is in Bitcoin. However, we will need a way, whether it's a centralized company. I love Swan. I think Swan Bitcoin is great. Bull Bitcoin is great as well in Canada. These guys are great, trustworthy, centralized companies. But there's also going to be trustworthy layer twos, whether it's an anchor chain like Stacks or whether it's something like Atomic Finance, where you're on chain making contracts with each other. So there is going to be tools. There are going to be financial tools and products that are built around Bitcoin equity that offer the same financial services that we see in the traditional system today. A lot of maxis are saying, well, it's Bitcoin only and you don't need anything else. Yes, when you're talking about the reserve asset of the internet economy, it is Bitcoin only and you don't need anything else. But are we really going into a future where all transactions are based on peer-to-peer exchanges? What if you just get rid of personal credit? Let's just say personal credit is moral hazard and we don't want to extend credit to people based on debt. If they want to take out commodity credit and borrow against their assets, that's fine, but no credit because it's a moral hazard. Okay, that's great. But there was credit when the gold backed the dollar too, but it was backed by equity, not debt. That's a difference. And what about a business? Shouldn't a business be able to borrow against its cash flows so that it can expand its supply, reduce its marginal cost of production, and then lower the front end price so that that demand can increase and they sell more units? There are a lot of financial tools, products, and instruments that exist in the world today that allow growth to happen at a faster pace. Now, don't take that as the Keynesian modern monetary theory lie that without credit, there can be no success. No, that's false. But there are specific financial tools and products that are going to be built around Bitcoin equity, and there will be a commodity credit market with Bitcoin as the most pristine form of collateral that allows us to facilitate these transactions going into the future. And they will be much more secure, much more safe. And by the way, they'll be under levered, right? Because when you go take credit, you're over levered. You're taking the promise of tomorrow's production. And what happens if you can't produce tomorrow? Well, there's nothing left. There's no value left to back it. But when you take Bitcoin and you borrow against it, and you borrow against, maybe Bitcoin's worth 100,000, and you decide, I'm going to borrow $50,000 against my Bitcoin. Okay, well, if you walk away, if you take that $50,000 you borrow and you walk away, the lender doesn't care. They don't care because they have principal plus interest being held as collateral. It's a much more safe and secure system, and it will facilitate different types of credit markets going into the future. It's a beneficial thing for the economy to be able to have commodity credit. And that means that's credit that's backed by real world equity, not credit that's backed by debt. So I just want to make that clear for people. Bitcoin is the reserve asset of the internet economy. However, there will be smart contract platforms, maybe some of them built on top of Bitcoin, and they don't have to be their own independent thing like Ethereum. But there will be tools and products that help evolve Bitcoin from digital gold to digital collateral. And if these people are acting like the Ethereans and trying to claim that they're hard money competing with Bitcoin, they're really just shooting themselves in the foot. You know, I said, if I was with them, I said, we should have did 1,000 to 1 split. For every 1 Ethereum you have, you get 1,000 more Ethereum. And then the price would have went from $4,000 down to $4. That would have let a lot more people enter the marketplace. But most importantly, the gas prices would have went down. So you were paying $100, you would now only be paying 10 cents for that transaction. And all these L1s, a lot of the shit coins, a lot of the scams, they really started because of the mismanagement of Ethereum, because of the misunderstanding that they had a chance to compete with Bitcoin instead of complement it. Bitcoin is the reason that everything else exists. So anything else that's built around Bitcoin to compete with it is a scam, and you should get as far away from it as you can. But if it's there to complement Bitcoin, due diligence is required to understand whether or not that's a sustainable ecosystem. And that's my thesis on the internet economy and the build out of future finance with a commodity credit market with Bitcoin as the base layer backbone of the entire system.
You know what? I may not agree, but I at least appreciate the thoughtfulness of the argument. I know there's a lot of ETH guys. I take a lot of shit on this podcast for listening to Bankless occasionally because I think they get good guests. And you know, I have a hard time with this ultrasound money thesis. It sounds like you do too. And so I'm glad to hear that even if you do own some of this other stuff, the ultrasound money thing is not has not cracked your shell. Now, you know, I can't, right? No, now CJ, you've been a great guest. Now, your last name, Konstantinos. I got to be correct in assuming you're a Greek, yeah?
That's right.
Okay, so let's do two things here. Are you a basketball guy?
I'm kind of like an all sports guy. I'm good at everything, but I'm not great at any one of them.
Okay. Can you pronounce the Greek freak's last name for us here and maybe set aside some of these mispronunciations that have prevailed over the years?
Well, maybe I should have been more clear. I like to play the sports. I don't like to watch them. No. So I don't know who that is. I don't know.
You got to find out. Okay. I'll tweet out after his name. You can say it and put it on Twitter because I'm dying to know. I've heard so many butcherings. The guy's name is Giannis Antetokounmpo, I think is how you say it. Yeah. Talk that. Now that's a name. It barely fits on the jersey. It's one of these ones that looks like half of the Golden Arch by the time you're done writing it. So CJ, before you go, first of all, great interview. Chat's been buzzing. A lot of people have been asking for you, been excited for this show. I want to give you a chance to tell people, you know, first of all, where they can find you, of course, but if you have a resource you want to share that helped you along your journey, you mentioned earlier, Dollar Vigilante, if there's other stuff you want to share with people, the floor is all yours, man. I think people, you know, they need to hear some other resources besides the sort of podcast and stuff that everyone listens to. So please, all yours.
Thank you. Yeah. And again, thanks for having me. I really enjoyed the conversation. Hopefully we'll be able to do it. We'll revisit some of these things in a few months as everything because you know what? In Bitcoin, things move really fast. The space is just exploding. But in traditional finance, things move really slow. But when you look at the world today, in traditional finance, things are moving extremely fast. And when they are moving this fast, it's time to pay attention. So I have a feeling in a few months, we'll be able to look back and say, wow, I can't believe we were talking about that because here's the reality. As far as finding out more about me, the best place to do that is to just follow me on Twitter. I did an interview with Adam Stokes. He motivated me to start a YouTube channel. He was the one who told me, you know, you have to do this for your kids. So you can find me on YouTube. I think the most important thing that I'm currently doing is that I'm working on a new business called People's Reserve. And People's Reserve is one of those companies that exists because of Bitcoin. It exists because all financial products in the future will be built around Bitcoin equity. So not ready to talk about it yet. I'm still under NDA, but there is a lot of reason to be excited for what's coming down the pipeline because Bitcoin is going to start to connect with the real world. It's going to be turning in from this magic internet money to life-changing real world asset. And the paradigm shift that we're going through is going to be exactly that. Bitcoin being, what's that saying? First they ignore you, then they laugh at you, then they fight you, then you win, right? So they did ignore us. They did laugh at us. Now they're fighting us and we will win. And Bitcoin centric companies are the future of all finance. So I'm super excited about People's Reserve. It's going to empower we, the people. All banks today are designed to extract value from people. People's Reserve is designed to deliver value back. So keep an eye out for that, because if you like how I feel about Bitcoin and how its role is going to be played in the future of finance, then you're really going to like People's Reserve. And that's pretty much it. Follow my Bitcoin Fair Value account because I give out miners are very competitive people. Okay. I'm competing with other miners. I don't want to give away my information. So my Bitcoin Fair Value algorithm, it is proprietary, but I do share it quite often on my BTC Fair Value account. And that helps people understand, if you're dollar cost averaging into Bitcoin, which I highly recommend because nobody can time these cycles. It's impossible, but it's much easier to dollar cost average aggressively when you know that the price of Bitcoin is trading for a discount to its fair value. And the fair value is based on its cost of production. The cost of production is the natural asset value. So if you can buy something for less than the natural asset value, it's a no-brainer. However, if it's trading for a premium, Well, maybe that's the best time to slow down the dollar cost averaging. Maybe that's the best time to buy your house or buy your car, and or buy a cash flow producing asset. Who knows? People use the tool in many different ways, but I'm one of the very few miners in the industry that shares one of their proprietary tools for management. And a miner's management is directly applicable to a personal portfolio management. So check it all out. Reach out to me, DM me. I'm trying to be as active for the community as I can. It's all about helping people and getting people ready, because truly, this is coming like a freight train and nothing can stop it. And it's coming a lot faster than the vast majority of people understand.
Outstanding. Thanks for coming, everyone. CJ, glad to have you on. And we will see everyone when we see you. Take care of yourself.
Thank you.
Well done, man.